To simplify your portfolio, do a little spring cleaning. It's bikini season coming soon, we hope. Our next guest says, let's slim down your portfolio. He says there are only 5 investments you need to own.
That's a slim portfolio. InvestorPlace.com editor Jeff Reeves joins us now. Jeff, I'm going to start right off with an argument with you here. We got biotech. I just read a piece talking about how pricey biotech has become and how much froth there is there, but you still see opportunities there. Why?
I do still see opportunities there, and I want to, kind of just say for the record, too, that I don't think that these are going to be swing trades. I think people got to be a little patient with it. But I've talked with you guys before about the demographic push that's behind healthcare. It's outperformed in multi-year periods. I think it will going forward. The reason I like biotech, that fund in particular, the XBI, is versus its peers. It actually has a bigger base of companies that's in there. There are a lot of smaller companies. It's not as overweight. The peer ETF that's out there, the IBB from iShares, actually has its assets allocated in a smaller number of stocks. It's got some really big stocks out there. So it's partially my love of biotech that gets me in there, but it's also the specifics of this fund. It's a little cheaper, a little more diversified. So while I hear you with some of that froth, I think that this particular fund mitigates that better than some others.
In essence, we were kind of overstating it. It's 5 ETFs with lots and lots of different stocks within them. So as we point that out, let's go to your next one. And aside from the smaller biotechs, I like that play, actually. You then say the Guggenheim Equal Weight Technology Fund. What makes this different from just buying a bunch of big name tech stocks?
Yeah, I think it's really, what makes it different from a bunch of big name tech ETFs is also what makes it attractive to me. I think people really got to look at the fine print. You got to understand what you're buying. We all talk about NASDAQ 5000. A lot of NASDAQ 100 funds out there, they're like 10% in Apple and 7 or 8% in Microsoft. So why not just buy Apple and Microsoft then? The reason that I like this fund is because it's designed to be equal weight. It's more diversified. In broadly, I think that technology is going to have a pretty good year. It's outperformed in recent history. And I think as we see the economy kind of pick up momentum, IT spending, consumer spending remains strong. I think it's going to benefit the tech sector, but I don't want to put all my eggs in one basket. If I wanted to just buy Apple, I guess I could, but if you're just going to do a diversified portfolio with a handful of ETFs, I think the equal weight route is much better.
IYW, for example, that ETF, 21% of that is Apple, so you're absolutely right. You want something a little more diversified. Dividends. We know about dividend appreciation. Vanguard has a great ETF there. Tell us about it.
Yeah, it's funny. I had a pretty good discussion on my article on MarketWatch and on Twitter. A lot of people out there talking about stocks that have a lot more yield, ETFs that have a lot more yield. The VIG that I like is because it's about kind of quality, not just the quantity of the yield. Dividend achievers make up this ETF. They're companies that have raised their dividend for at least 10 consecutive years straight. The yield's a little bit lower than some other ones, so the total return isn't as high. But again, these are very high quality stocks with sustainable dividends that consistently raise year after year. So if we're going to get growthy with some of these biotech and technology companies out there, I think if you want a very firm foundation in these dividend stocks, you don't just want to chase high yield REITs or junk bonds, right? You want to have stability that's going to be there for the long term. And you can get it for a cost basis of 0.01 for an expense ratio, which is $10 per $10,000 you invest.
Ooh, nice.
That's Vanguard's thing. I think this is a very stable and cheap fund for you to put in your portfolio.
Do not overpay fees, folks, really. Okay, now you talked about getting growthy. Now let's get internationally. Everybody should have a little bit of international in the portfolio. Where do you go for that?
Yeah, I think that there's a lot of value to be had overseas right now. Some of your people in the market panel just kind of discussed this earlier. I agree with that notion. So where are you going to go if you don't want to double dip, if you don't want to get some of those large cap stocks that are in other ETFs or other mutual funds out there? I go with an ex-US fund, the VXUS actually. Ex-US means everything that's not in America. So this is kind of your one-stop shop. It's about 50% in developed markets like Europe and Japan. So you've got those big large cap companies that just happen to be in developed markets elsewhere. But you also have a little bit of emerging markets exposure in Latin America and in Asia Pacific. So I think people should have emerging market exposure. You shouldn't be too overweight. So I kind of like this fund because it's about 20% in emerging markets.
As you can tell, Jeff has a lot to say, and if you've been keeping count, we've only had 4. There is a 5th, by the way, preferred stock. If you like preferred stock, Jeff suggests PFF. Look that stock symbol up, the U.S. preferred stock ETF. That's what Jeff likes. Sorry, Jeff, we ran out of time, but thanks a million, buddy.
That's okay.
Check out the article from Jeff at investorplace.com.